Welcome back. In today's video, I'm going to be showing you how to use and how to spot a break of structure, bullish and bearish, and how they form, and how you can use them with higher time frame confluences. So, as you see here, I am in replay mode on 15-minute on gold, and I'm going to be showing you an example of a bullish break of structure. A next example will be bearish. So, verbally, I'm going to tell you how a break of structure forms, then we're going to apply it onto a actual chart here on gold. So a break of structure, a bullish break of structure, forms when price purges sell side liquidity, then violates a swing high that was created before sell side was purged. So let's go in replay mode and see this bullish example. As we see here, we have liquidity resting here. It can take out any one of these points. It doesn't have to sweep all these points, but it can at least purge one of these points of liquidity. So that's what we're looking for. And our bias is bullish here. So we want to look for some sort of bullish break of structure or a sell side sweep of liquidity before the break of structure occurs. So let's see if that happens. As you see here, that does happen. Now, you might have noticed this swing high. This swing high is now created. So keep an eye on that swing high there. So we now know that sell side has been swept and or purged. Liquidity sweeps and liquidity purge are literally the same thing. There's no difference. There's no, oh, why do people call it sweeps? Oh, why do people call it raids? Oh, why do people call it purges? They're the same thing. They're the same thing. Now, there is a difference between liquidity run and liquidity purge. There's a difference, but I'll get into that on a different video. But liquidity purge, sweep, and raid is the same exact thing. They're literally the same exact thing. But anyways, continuing with the break of structure setup, we see that price has swept sell side, and now we want to see price come back and violate this swing high. So let's see if that happens. That exactly happens. Price comes up and aggressively violates this swing high. That right there creates your break of structure. Okay? Now, how do you enter off this model? You want to find a fair value gap within the range of the break of structure occurrence. So as we see here, from this high to this low, right? Which is the price leg of the break of structure, you want to find a fair value gap within that range. A bullish fair value gap in that range. Not a bearish, a bullish fair value gap, because this is a bullish break of structure. Now, there is a bullish fair value gap right here. And is it in the range? Yes, it is. It is inside the range. It doesn't matter if it's in a premium or a discount. It just has to be in this range. Okay? Now, how do you spot the price leg? And how do you find the fair value gap? First, the price leg. The price leg is the most recent swing high before price comes down and purges sell side, right? And the low that's created when price purges sell side to the high that was created before price purges sell side, that is your range right there. So I'm going to say this again. The swing high, well, the most recent swing high that is created before sell side is purged to the low that is created after sell side is purged. So as you see here, swing high that is created before, low that is created after the purge. And that is your range. If you want to drag that out, this is your range. And you want to see a fair value gap in that area. And there's a fair value gap right here. Now, we want to see price come back into this area and push up into buy side liquidity here. We do have buy side liquidity here, and we're going to target all the way up here. That's our target right there. Buy side liquidity. So we want to see price come back and retest this fair value gap. And if it does, we are going to place a buy and set our target right here at buy side liquidity. Price comes back into it. We what? We buy. We can set our target at buy side liquidity. And there's two places you can set your stop loss. You can set your stop loss at the bottom of the second candle, at the bottom of the second candle's fair value gap creation. So if you do know, fair value gaps are created within 3 candles. So you can set it at the bottom of this bullish fair value gap creation right here and the second candle, or you can set it at the bottom of the break of structure. So the low of the break of structure price leg, and that will still be a good stop loss. But I recommend you using this. If it's not extremely tight, you can use the bottom of the second candle if it's not too tight of a stop loss. So now we're going to play this out and see if price runs through our take profit. Let's play it forward. And price does just that in a displacement fashion. So now I'm going to go on to a bearish example, which is basically the same thing, but is quite the opposite because it's a bearish example. So here's another example, well, not another, but an example of a bearish break of structure. So it's completely the opposite of a bullish break of structure, but it's not too hard because literally you just take a plank or piece of wood and basically just flip it upside down. But anyways, enough analogies, let me actually get to explaining. So with a bearish break of structure, the first step is you want to see a sweep and or purge of buy side liquidity. So we do notice these two highs here, this high and this high. Like I said before, both of these highs do not have to get swept. At least one has to get swept. And as we know, or should already register in our heads, our bias is bearish for this day or for this setup, correct? So first we want to see one of these highs get swept. As you see here, price comes up and sweep the high. Now we want to look for a swing low get broken, the most recent swing low. The most recent swing low is right here. I'm not going to drag it out too far, but that is the swing low that has been broken. That most recent swing low right there. So we will be wanting to look for a fair value gap within that price leg of the low and high that's created when the break of structure is occurring or has occurred. So you want to look for a fair value gap within this range. Or an implied fair value gap. I also forgot to mention that. You can look for an implied fair value gap within the range if your bias is correct. That must be a part of the rule. If you're looking for an implied fair value gap, you must have your bias correct. Everything must be correct if you're looking for an implied fair value gap, or if there's no regular fair value gap. But anyways, let's continue with the example. So as you see here, there's a fair value gap right here in this range. Or if we drop down to a lower time frame to really find something that's in the range, like the 5-minute, for example, there's a fair value gap right here, right there. There's a fair value gap. So we want to see price come up to this fair value gap because it is barely in the range here, but it still works. So we want to see price come up to this fair value gap and displace downwards. Let's jump back on to 15. This is the same fair value gap, just on a lower time frame. And let's watch price. Price barely comes up to it. Price comes up to it and displaces downwards. Now, let's reverse this back and place a trade, shall we? Price comes up into the fair value gap, and that's where you would want to place your sell. We sell, and you can set your take profit at any of these lows. Let's set it here, right there at that low, just to keep ourselves safe. Does price hit it? Let's see. Price does indeed hit it. So I hope that helps you understand what a breakup structure is and how you can really find them and use them with higher time frame concepts. I didn't really get to the implementing them with higher time frame concepts, but I think you should be able to handle that on your own. But anyways, I'm not gonna make this video too long or yap or talk for too long because I know you guys got things to handle. But anyways, I'll see you guys tomorrow. Bye.